Hi everyone, in this lecture I will go over the assumptions that underpin the capital asset pricing model, which is what we will be using to coming up with a discount rate for risky cash flow or risky returns. So today's agenda is the following. First, I will kind of be more explicit about the motivations from last week. As you know, from last week we went over how to construct portfolios, but we weren't explicit about what our objective is. Should we just be focusing on minimizing the risk of the portfolio, or should we consider choosing a maximum return, for example? So today we're just going to be explicit about our preferences, and it should be clear what our objective function when it comes to when it comes to constructing a portfolio of assets. All right. Secondly, I will talk about efficiency portfolios and risky assets. So again, once we establish the assumptions of our preferences, we're going to try to come up with ways to measure how efficient our portfolio is with respect to our objectives. Third, we'll talk about portfolio choice and Sharpe ratios. Number 4, we will talk about financial market equilibrium. So this is kind of the assumptions we need to make in order to make our capital asset pricing model feasible or tractable or usable in our context. And number 5, we will get to the capital asset pricing model and its formula. So you most likely have seen this in your other courses or have seen this in the homework assignment or the ungraded homework assignment. And lastly, we're going to talk about how to go estimate certain parameters of this capital asset pricing model, or specifically this beta. Okay, so recall beta is our way of measuring exposure of certain assets to risk depending on its correlation to a risk factor. Okay, and to reiterate, our risk factor that we're going to only consider is the intercorrelations between assets that can be diversified away. Okay, so that is our source of risk. Okay, so just to recap what our goal here is, our goal is the following. Our goal is to come up with a discount rate for risky asset I, right? But it's going to have the following form. It's going to look like it has a risk-free component or risky return plus some variable that captures additional risk that should be compensated, right? So I'm going to call this additional compensation for risk. Okay, so today's task is to come up with an expression for this additional compensation for risk. Okay, so far we have seen how to quantify risk and return, as well as how to estimate risk under historical data. So that means we can take an average over a certain period of time, and also we can look at its variance or standard deviation of a particular asset and use that as a proxy for risk. And last week we talked about portfolio construction. So once we know the risk and the mean return, we can form portfolios and then quantify the return of that portfolio and also the risk of that portfolio. And we made a keen observation that given imperfect correlations of assets, you will get this diversification effect. Okay, but there's a limitation to this diversification effect. You can only diversify, that is, by adding imperfectly correlated assets into your portfolio to a certain extent, and whatever is left over is what we call undiversifiable risk. That has to be so-called priced into our capital asset pricing model, and that return should be capturing only that type of risk. But today we're going to kind of be a little bit more explicit about our objectives when we come to forming portfolios. So when I say objective, I mean what is our preferences when it comes to these features of assets, namely its return and its variance. So let me be explicit here. Our goal is to define objective in the sense that we want to know our preferences. What are our preferences when it comes to portfolio construction. Okay, so as you know, there's basically two parameters we're thinking about. There's the mean, so I'm going to write expectation of RP to designate our mean return of our portfolio, and I'm going to simplify this variable or expression a little bit more and just use the Greek formula or Greek letter mu. Okay, so mu is going to represent our mean return of our portfolio, and the other parameter we're thinking about is sigma, or sigma squared, to designate our variance, right? Our variance of our portfolio. You can take the square root and just use sigma, and that's our volatility or standard deviation. Either way, those are the two parameters we're thinking about. And what we want to pinpoint today, or be more explicit, is that our goal is actually not to maximize the return solely, or to minimize the variance purely in that sense. We don't want, there's an obvious trade-off between mean and return, and we kind of want to have a balance of both. And so our objective is actually the following. We want to give you a little look ahead. Our objective is to minimize, essentially, the volatility or the variance of our portfolio. I'm going to use the subscript P to indicate portfolio, such that the mean of our portfolio is going to be greater or equal to our pre-specified desired return. So let's just call that mu. Okay. So hopefully this makes kind of sense. So when we're minimizing the variance, the parameters we're choosing is actually the weights that are associated to the assets we want to include in our portfolio. So I'm going to use maybe W to indicate that we're talking about weights. We're choosing weights such that the variance or the standard deviation or the volatility of our portfolio is minimized, subject to a constraint, right? That constraint basically says that I have to earn at least this amount of return, otherwise it's not what I want. Okay, so of course what's going to happen if you've taken some optimization course is this is going to be an inequality, primarily because this objective function is concave. Okay, so you don't have to know what that means. It just means that given that variance by definition has a certain shape such that it has a global maximum or minimum, in that situation this constraint has to be equal, okay, because there is a distinct trade-off between mean and return, variance and return. If that's something that's a little bit cloudy for you, don't worry about it. Things will be much clearer once we get to when we talk more about the objective function that we're trying to attack or tackle to. Okay, so first things first, what we're going to do is we're going to make some assumptions about our preference structure. Make assumptions about structure of preferences. Okay, and once you nail that down, things will be much clearer what our objective function should be and what we should minimize or maximize. So based on this equation here, it sounds like we should be averse to volatility, right? Because we want less of it, which should increase our happiness. And higher returns, right? That's why it's a greater or equal to, will make us happier as well. So there is a balance, right? We want less of something, but we want more of something, but we want to have as much of both, right? Less of something and more returns. Okay, so let's kind of visualize those preferences using some graphs. So we're kind of revisiting some topics from microeconomics. So if you had training or have you taken a course on this, that's great. But if not, I'm just going to go over some graphs to represent our preferences, and then use some calculus to kind of figure out what risk aversion really means. Okay, so this is an important assumption that we eventually have to make in order to utilize the capital asset pricing model to discount our risky cash flow. Okay, so efficient portfolios and risky assets. So let's talk about investor risk preferences. So most investors, as I already said, prefer more returns to less. So having more of something is going to make us happier or better off, and less risk is also preferred as well. Okay, so how do we compare securities with different risk, different returns, and different risks? So it all really depends on your risk preferences, and we're going to try to represent this using some graphs. So in this graph, on this slide, we have expected returns on the y-axis. So that's this axis here. Sorry, markup. It's this axis here, and our standard deviation is our x-axis, which is this axis here. So just based on this graph, the less volatility or standard deviation we have, the happier we are. Okay, so we want to go towards this quadrant or this side of the graph, right? We want less of standard deviation, but at the same time we want more of returns, right? So we want to go up along the y-axis, but we want to go left along the x-axis. So our happiness, or what we use in economics to represent happiness, is called utility. The more returns and the less volatility our portfolio has, the higher utility or happiness we will get. So that's what this arrow means. It means that as we move from this point here to any other point to the, so this is much clearer if I draw this line here. If we move anywhere inside this dotted line, that kind of makes it a box, right? So anything inside the box will make us better off. So this point is going to make us better off. This point will make us better off. Any point in there is better off. But if it's outside the box, it may or may not be better off, okay? And so we typically represent our preferences with what's called indifference curves. So if we are on, let's say we are this dot here, for example, depending on how we formulate our utility function or a happiness function, we can move along this line and we would actually be indifferent. So that means that this point here gives you the same happiness as this point here, but if the point is outside of this indifference curve, it could make us worse off. So this point here is definitely worse off, right? Because there's less return and more risk, but anything inside this box is going to make us better off. Okay, so we typically draw parallel lines to represent indifference and happiness for different portfolio sets, but anything within these dotted line boxes will make us better off. Okay, so that's kind of our representation of our preferences, and so that's visual. But let me give you some mathematical rigor for those of you who seek it. So we typically represent utility using a function. So let's give that a letter. So let's call that U. And we know based on this graph that there's only two parameters to our utility function or a happiness function. And let's call that R, which is our risky return, and sigma, which is the volatility of our return. Okay, and based on what I described to you, we can actually represent our preferences based on its sensitivity to changes in these parameters. So let's change our utility when we change returns just a little bit. So as I described to you in the last two slides, having more returns is going to make us happier and better off. So increasing R just a little bit is going to make our utility increase, right? So therefore, this relationship between U and R should be positive. So this D character is actually a partial derivative. So taking the partial derivatives, a derivative of U with respect to R is going to give us a positive sign, positive relationship. So this just means more returns, more happiness. Conversely, if we take the sensitivity of our utility or happiness with respect to sigma, it's going to be negative, right? Because more risk is going to make us more worse off, less happy. So there's going to be a negative relationship between volatility and utility. Okay, so how do we represent risk aversion, and how do we compare risk aversion between different investors? We can do this by observing that we can take the total derivative of u and set it equal to 0. So let's do that first. Again, this is just calculus concepts. If you don't know what that means, that's fine. But once I work through the math, I think it should be quite clear how to compare risk aversion between investors, depending on how you formulate their utility function. So let's look at the total derivative of u and set that equal to 0. So partial u partial r times dr plus partial u partial sigma d sigma, set it equal to 0. Okay, and then let's rearrange the terms such that we're looking at dr d sigma. Right, that's what we want to look at. What's the trade-off between risk and return? And that's so. And you should note that based on this graph, this is simply the slope of indifference curve. And these are called indifference curve. All right, so let's rearrange the terms from this, what we did here. We will get negative partial u partial sigma divided by partial u partial r. These are both positive, right? Because du over d sigma is negative, multiplied by a negative sign is going to be positive. And du over dr is also positive. So this entire coefficient here, or this relationship between r and sigma, is going to be positive. Okay, so let me give you some verbal explanation of what this is saying. This is saying that if we increase dr d sigma, that means that for each unit of risk, demand for returns is higher, right? So that's kind of another way of saying that this person is averse, much more averse to risk, if its sensitivity to changes in sigma is greater. Okay, so another way of saying this person is much more risk averse, and what that means is that the slope is steeper. Okay, so based on this mathematical explanation, it should be quite clear that using this graph, the steeper the slope means that this person is more sensitive to changes in risk because they demand more return per unit of risk. So which means that if we want to think about a person who is completely, basically almost risk neutral, they're going to have a very flat, right? Very flat indifference curve. And we'll see that through some examples in just a bit. Okay, so to summarize this slide here, we're trying to represent our preferences mathematically, so it makes sense how we should construct our portfolio. We should construct a portfolio such that we have a pre-specified return, and we try to minimize risk as much as possible, right? And we can capture these preferences using this function, u, which takes two parameters, because we're only thinking about two parameters in this case, right? We only care about our portfolio return and the portfolio variance. And we can represent this preference for disliking volatility and liking returns by taking the partial derivative of our utility function with respect to returns, and volatility. And we should expect a positive relationship between utility and returns and a negative relationship between utility and volatility. Now, if we want to understand risk aversion across different investors, we can move on to capturing this relationship by using the total derivative technique and then setting it equal to 0. And then realizing that this relationship, this trade-off between risk and return is going to be positive. And depending how positive it is, will tell us how risk averse somebody is, right? Because the more positive it means that per unit of risk, this individual will demand more returns. That's what risk aversion means. Okay, so let's move on to examples of risk aversion. Okay, so let's think about two types of investors, A and B, and let me draw some indifference curve, and we can kind of figure out which one is better off, which portfolio is better off. So remember, portfolios are basically represented in two dimensions. It's return and it's variance. And the question is, which portfolio would you prefer? And again, it depends on your preferences. So let's assume that we have an investor A with a steeper, more positive slope indifference curve. So let's draw an indifference curve that's steep. And let's call that investor A. And then let's call investor B the following indifference curve that is flatter. Okay. And then let's draw the dotted boxes just to make sure it's obvious that one portfolio is dominating another portfolio. Okay, so this question asks you which stock would you prefer. So it's quite obvious which one dominates. Portfolio 1 is within the dotted box of portfolio 2. So that just means that portfolio 1 is superior in risk and return dimensions. So both A and B investor would prefer 1 over 2. So let's summarize what I just said. Portfolio 1 has less risk, and we're summarizing risk in terms of standard deviation, and also 1 has higher returns. Okay, so therefore portfolio 1, and I'm going to use a squiggly greater sign to indicate preferences, is strictly preferred to 2, right? Based on our assumption that we don't like risk and we prefer more returns whenever possible. Okay, so hopefully that's quite obvious based on this graph. Okay, just remember that the dotted line technique, once you get that down, is quite obvious that as long as there's another portfolio that's within this dotted box and closer to the x-axis and higher, closer to the y-axis and higher along the y-axis is always better. Okay, so let's look at this following graph. So again, let's presume that investor A has a steeper indifference curve. So let's do that. A has a steeper indifference curve. Well, maybe that's too steep. Let's just be more realistic here. Okay, that's investor A. And then investor B, again, has a relatively flat curve. And let's draw the dotted box again for each of these portfolios. Okay, so based on this graph, it should be quite obvious that one portfolio is not necessarily better than the other, because portfolio 1 is not within the dotted box of portfolio 2, and nor is portfolio 2 within the dotted box of portfolio 1. So really it depends on the risk preference of the investor. Okay, so for what does investor A prefer? So based on this graph, it seems that investor A prefers portfolio 1 over portfolio 2, right? Because we're moving in this direction here, right? As long as we're moving in that direction, our indifference curves, remember, are parallel with one another. And so as long as our indifference curves are moving toward the y-axis, and that's going to give us higher utility. So for investor A, 1 is preferred to 2. For investor B, 2 is going to be preferred over 1. Okay, so there is no universal preference here, and it depends on risk. And based on our definition, right, of risk aversion, it should be obvious who is more risk averse. Investor A is definitely more risk averse because its slope is steeper. So that, again, that means that per unit of risk or net volatility, investor A demands higher returns. So investor A is more risk averse. And this is quite obvious, right? So once we go from portfolio 2 to portfolio 1, the volatility decreases, but the returns declines. So by a lot. Okay, so that's hopefully a clear understanding of what our objectives is now. So our goal is to kind of figure out what's the space of possible portfolios that we want to hold based on our preferences for not liking volatility and liking returns. And we can represent this possibility by actually varying the weights of our portfolio, and then therefore outlining a graph of possible portfolios that we would hold. Okay, and that gives us this possibility, that gives us the relationship between expected returns and the volatility. So let's go over an example. So I placed this file in the week 7 module. So you can take a look at this, but I'm just going to summarize graphically what we did in that exercise. Okay, so you don't have to spend too much time on that if you don't want to. All right, so in this slide, it asks you to find the expected return and standard deviation for portfolios of 2 stocks. So I kind of already gave you what I have, which is what you will find in the Excel sheet. And the question is that now assume that you're going to build a portfolio of just these 2 stocks, and we're assuming that the 2 stocks are uncorrelated. So the correlation coefficient rho is going to be equal to 0. Okay, so your task, therefore, is to kind of visually represent the relationship between returns and volatility for a portfolio of these 2 stocks by varying or changing the weights for arbitrary levels. Okay, and what you'll see is when you plot the mean return and volatility, you'll have a figure that looks like the following. You will get a figure that looks like this. You get a C-shape graph. And if you decide to plot your mean return of your portfolio as the y-axis and the volatility of your portfolio as the x-axis. And so the question that's being asked here is which portfolios are definitely not the ones you would buy, and the ones you definitely would not buy is the portfolio that gives you negative returns, right? Because you're better off just holding on to cash in that sense. So if your expected returns is negative and it has positive volatility, that's a portfolio you should definitely not hold. So let me summarize. This is negative returns, but positive risk, right? That's definitely something you don't want, because you get worse than nothing, and you have more risk. So it doesn't fit. It's definitely a dominated portfolios, because for any kind of risk here, let's hold risk constant, right? Let's hold risk constant here. So let's draw a dashed line here. So for this amount of risk, you can actually get a higher portfolio if you decide to hold, a portfolio with certain weights that gives you this amount of return. So this risk here should not even be considered, or this portfolio with this risk should not be considered if it gives you negative returns. Okay, so that's what the plot looks like. So let me give you the instructions just in case what I said is hard to follow. So what I wanted you to do is to calculate two expressions. Calculate the expectation of your return of your portfolio, which is simply the weight W times the mean return of Intel plus 1 minus the weight. So whatever amount of money you have that's not placed in Intel is going to be placed in Coca-Cola, and therefore you would get a expected returns of ER Coke. All right. And also now plot or calculate the volatility of this portfolio depending on what W is. And so let me write down the formula. It should be quite obvious, to be honest. So that's just the square root. So sigma is equal to the square root of variance RP, and that has a formula. It looks like the following. It's W squared plus the variance of our Intel plus 1 minus W squared variance R Coke. And then, as you know, we have this covariance term. This is covariance, which is between R Intel and R Coke. And since there's so I'm going to draw a line there because we're still square rooting it. So because the correlation coefficient is 0, this last term goes away. So all you're considering really is just these two terms. Okay, this term here. And your task, therefore, is to vary portfolio weights, W. So that means that let's choose, for example, choose W between -1 to +1, and then put some intervals in between, such as 1.5, -1, -1, 0.08, 0.07, blah blah blah, all the way to 1, right? And then plot the coordinates for the weights and volatility point pair, right? Because you'll get, so I'm going to use mu here, so you'll be able to generate mu and sigma I, right, for every different weight you decide to use. All right, so that's what you were supposed to do. So just to summarize what I stated last week as well, you can obviously have negative portfolio weights. Negative portfolio weights simply means that you are shorting a particular asset or stock. Short means that you have sold something today with the intention to buying it back and returning that asset to the person that lent you the asset. Okay, so if that doesn't make sense, it means basically you're borrowing something and you have to return it at a future date, but you're allowed to sell it now, and as so long as you cover, quote unquote, cover your position, you are fine. And typically for trading platforms, there is some sort of margin that you have to set aside, meaning that if you sold the asset today and your portfolio falls below the margin, then the brokerage may actually buy back the asset for you. And so depending on how how much you short, you could lose a lot of money if your brokerage decides to liquidate your position. But in any case, that's kind of a trading detail, but that's what shorting means when you decide to construct a portfolio. It just means that you are borrowing money by selling something today and then investing that into another asset. So you can have a negative weight on Intel, for example. That means you're selling Intel today and you're expecting to buy it back, hopefully at a lower price. And you're taking that amount of money today and investing it in Coke. Okay, so that means to go long. So let me kind of remind you, the opposite of short position is a long position. A long position means that you are buying that asset today, expecting that asset to grow over time so that you can sell it at a higher price. And to buy back, remind you, also means to cover your position for the short position. Okay, so that's kind of an aside. All right, so let's get to the topic of efficient portfolios. So in the example I gave you with Excel, we only talked about two stocks. We had Intel and Coke, but of course we can include much more stocks into our portfolio. But as you realize, your so-called set of possible portfolios will regardless have a C shape. So in this case, we have Intel and Coke. So the black line is represents any portfolio you can take on between investing in Coke and Intel. The dark blue line represents 50-50 in Intel, but you're going to vary the weight on Bohr. Okay, so Bohr is another company. And you should also get a C shape. The light blue line, there's two light blue lines. So the line with just B plus I. So let me remind you what B and I stands for. So B again means Bohr, I means Intel, and C stands for Coke. Okay, so this means all possible portfolios with I and C, with combinations of expected returns and volatility. This dark blue line means 50-50 in Intel and Coke, but you're varying the weights between B and this portfolio 50-50. So you can think of it as W times B and 1 minus W times 50-50 C. So you just multiply the 50 times 1 minus W, and that should give you the weight, the actual weight. And then we have B plus C. So same idea, where all possible portfolios between Bohr and Coke, it should give us this following set of portfolios. So what you should notice is that once we include more assets into our set of possible portfolios, this C shape would actually grow towards the y-axis. Okay, so in fact, if you have B plus I plus C, it should be something that looks like this. Okay, so that's this thing. So B plus I plus C should subsume or encompass all possible portfolio sets if we decide to only take a subset to form portfolios. But the idea here is that you get much more efficiency if you include more assets into your portfolio. That means for the same return, you can get much less risk if you open your portfolio to be available to invest in more assets, the better. Okay. So this is slide 10. All right. So let's move on. So as I already said we have the efficient frontier of 3 stocks. So what I just described to you, the set of possible risk return portfolios combination is represented by this C. Okay, this C, and the C curve will shift towards the y-axis once you include more and more assets into your portfolio. And in fact, what this is saying is that any other combinations with fewer assets is going to be less efficient. And you can see this clearly in this graph. So let's do this let me give you an example. So let's take one specific expected return of 10%. So let me draw just a horizontal line at the 10%. And you'll see that if we only considered Intel and Coca-Cola, it would require a much higher volatility than if we decide to include Bohr into our portfolio in addition to Coca-Cola and Intel, because the risk is lower. So remember, for the x-axis, we are happier if we get closer to 0%, whereas on the y-axis, we're happier when it's higher, okay? So in this case, at expected return of 10%, we would have an efficiency gain if we decide to include Bohr in our portfolio so that we are here rather than here, okay? So if we include Bohr, we can move from this frontier to this most outer frontier. Okay, so I'm going to use the word frontier to describe this C-shaped curve that we've been talking about. Okay, so I should be kind of clear what our objective is now, right? So based on this graph, we want to be able to fix some return that we want. And given that expected return formulates portfolios, that means choosing the weights such that the risk is minimized. So minimize, so as I stated it again, our objective has always been, since last week, to minimize the variance or the volatility, it doesn't matter, by choosing the weights such that, so I'm going to use ST to indicate such that, which is a condition that must be held, our expected returns on our portfolio is at least as great as our desired level of mu. So we're going to choose mu and also choose W such that our risk is minimized. That is the portfolio math that underlies the capital asset pricing model, which we will derive shortly in this lecture. Okay. The math is actually quite complicated. I'm afraid I will have to discuss this in a separate lecture. But for this video lecture, I'm going to try to be as intuitive as possible in my explanation. And don't worry too much about the math because I'll explain that separately, which will be used for your homework. But for this case, as long as you understand the intuition, that's the most important objective here. All right, so let's look at a portfolio of many stocks. So I think there are 10 stocks or more here. So how do we construct a portfolios of 10 stocks, and what does that look like when referenced to just a portfolio possibility of just a few stocks? So with just 3 stocks, so in this case, in this graph, we have just 3 stocks for the dotted line. We have Mobil, which is an oil company. We have GE, conglomerate, IBM, another conglomerate. Our efficient frontier is only expanded to the dotted line. Okay? And as we include more stocks, so as you can see in this graph, we have more than just Mobil, GE, and IBM. We also have Disney. We have a pharmaceutical company, Merck. We have Anheuser-Busch, which is a beer company. We also have Campbell Soup, a food manufacturer. Anyways, they all have different correlations with each other, and as you know, based on last week, this will give us diversification benefit. and it's up to us to kind of figure out what that weight should be such that variance is minimized. And we can represent this set of portfolios that can be achieved based on a large portfolio of 10 stocks by this solid line here. So as we expand our 3 stock portfolios to a 10 stock portfolio, our efficient frontier is shifted outward. So our efficiency gains is definitely expanded. And again, the way to see this is draw any horizontal line, let's say 5%. We can see that this 10 stock portfolio can give us a volatility of somewhere around 15%. But if we rely on just a 3 stock portfolio of Mobile, General Electric, and IBM, our volatility is stuck around 20%. So definitely we want to be able to construct portfolios that give us a better risk-return trade-off, right? And obviously a larger portfolio is going to give us that compared to a small portfolio of stocks. Okay, so something you should note, I want to point out before we move on to kind of another aside, is that this point here is typically called the global minimum portfolio. So that means that we are minimizing risk, just risk, without any sort of constraints, and we're not having any return condition. So simply just minimizing variance, choosing W, or minimizing volatility, doesn't matter, same thing. But there's no restriction on return. We don't have a pre-specified expected return. Okay. And also something I want to mention before we move on is there's maybe some people confused that why would you ever demand 5% when you can get this return here for something closer to 10%. Let's call that maybe 7%. And I agree. So definitely any portfolio in the blue line is definitely dominated by the red line, right? Same thing here. But this is just for demonstration purposes when we're comparing 2 frontiers, right? It's clear that the frontier that's closer to the y-axis dominates the frontier that's further away. But once we fixed our volatility, we can always get better returns if we move to the red line rather than stay on the blue line. So technically, we should only be considering portfolios that are at this intersection. So the red frontier is all we should really care about. Okay, so an aside I want to talk about is that this capital asset pricing model, or this portfolio optimization math, is not restricted to simply equities and stocks here. We can definitely apply the same math to any other asset that can be quantified in terms of returns and volatility. Anything such as real estate, right? Real estate is big in Asia, and that should be part of one portfolio, and that shouldn't restrict us as financial practitioners for excluding it in our frontier, right? It definitely has some diversification benefits. You can also include mortgages. These are certain types of personal debt that can be traded. You can have patents. Patents are not as liquid, but you can still quantify its returns based on past sales. You can have bonds. We didn't include this because in this course we're assuming that bonds are risk-free. You can have other commodities such as gold and orange futures. So orange futures are actually derivatives, but derivatives also has a risk and return component which can be estimated and therefore included in our portfolio. And just to be a little bit silly and facetious, you can include Bitcoin or even works of art, right? Works of art, like antiques, Picassos, whatever. They all have risk, right? It could decline in value. It can increase in value. It can have, therefore, can have return, and it may have volatility, right, as well. If you have war, if you have an invasion or a war, its value is going to skyrocket. So there's definitely volatility component for works of art as well, if you think about it. All right, so let's now think about including the risk-free asset into our portfolio. So far, we've only looked at risky assets, right? We only looked at stocks such as IBM stock, GE stock. But what does this frontier look like when we decide to make it available, including risk-free returns? And once we have that component introduced into our portfolio math, then we can talk about this concept or definition called the Sharpe ratio. All right, so as you already know, based on the math of last week, we have diversification purely from just adding assets including into our portfolio. And today we kind of saw that our possible set of portfolios of as represented by combinations of expected returns and volatility becomes more efficient as we include more assets into it. And another way to decrease the risk even further is by adding a risk-free portfolio. And we can see this by simply doing some basic algebra. And then we will see this graphically in the next slide. So let's consider what's going to happen when we decide to include the risk-free asset. So let me remind you what these variables mean. So let's assume that X is the amount of investment you decide to put in risky assets. So X is, you can think about the weight in risky assets. Sorry. ASSETS. And RP is our risky return from our portfolio in risky assets. So that's this term here. And then whatever is left over or borrowed is going to be in this expression here. So 1 minus X is whatever investment is left over, and that's going to be deposited in a risk-free account or a riskless return asset such as a US government bond. And you will generate a return of RF. Okay, so therefore our augmented portfolio, allowing ourselves to invest in a riskless asset, is going to have the expected return of this following expression. Okay, and what does our volatility of our portfolio looks like? We can see that by just taking the variance of this expression here, without the expectation, of course. And since RF is a constant, it's known beforehand. Remember that when we add any constant to a random variable, that's gonna give us the random variable, and therefore our volatility is simply going to be scaled by how much we decide to allocate into our risky asset. Right? So this X is the same as this X, but because it's a constant that we just added by augmenting our portfolio to include riskless assets, that term goes away, and so the standard deviation of our new portfolio is just a scalar of our volatility of our original portfolio by the weight we now decide to allocate into that, only into the risky assets and not into the riskless assets. Okay, so it should be clear what this looks like, right? So let me clarify what I said with the properties of variance. So remember that if we have a random variable, let's not use x. Let's call it r plus rf. Rf is constant. That's just going to give us variance of r, because rf is a constant. So it doesn't matter when it comes to calculating the variance. Okay. Now, let's see what our portfolio looks like visually. Okay, so recall the previous formulas. We kind of chose an arbitrary risky portfolio, right? We don't know where that's along the frontier, but it's definitely in the red part. And let's just say the risk-free return is 5%, and therefore, not surprisingly, it's going to be a linear relationship, right? Because we're simply just shifting weights from one parameter, one return to the other, and so this relationship should definitely just be a straight line. So that's represented by this yellow line here. Okay, so what should be interesting is that if we are in this part, as I noted here, this part of the yellow line, what we are actually doing is investing positive weights in both risk-free asset and the risky portfolio. But once we get to this part of the portfolio, we are leveraging. So that means we are borrowing money from the risk-free asset and investing in the risky asset. Just based on this graph, it should be quite clear that once we get past this point here, these portfolios on the yellow line are strictly dominated by just holding on to the risky portfolio, right? We can see this again by just simply drawing a vertical line that intersects these, for example, 150% x and 200% x. So let's just do 150% x, which has it looks like a volatility of 12%. You get a much higher return than if you stuck with this portfolio on this line here. Hopefully you see that. So what this tells you is that we should try to find a way to kind of shift this curve so that it's sloping steeper, right? Obviously, these points are dominated by the red portfolio, right? So remember, when we're on the red frontier, we are no longer investing in the riskless asset. We are simply investing. All of our money is invested in risky assets. But it seems that when it comes to this portion here, we could get better returns, right? Because for example, in this point here, on this, let's just say this intersection here, right at where the red and blue line touch each other, we can get less risk for the same return. So definitely there is a benefit for including the riskless asset into our portfolio for some circumstances. But when we decide to leverage at the risk-free rate, our portfolio becomes dominated by the risky asset. So visually, it seems obvious what we should try to do. It really depends on what we choose for P, right? So if we try to move P such that the slope of the yellow line becomes steeper, we can actually improve our set of possible portfolios and expand our frontier to more efficient portfolios, right? We should try to increase this such that we get a tangency, right? Something like that. this should be our portfolio, right? Some intersection. So I don't want to get too far ahead, but our goal in next week's homework, and in most cases as practitioners, is try to identify what this so-called tangency portfolio should be. Because once we know what this tangency portfolio is, we have the most efficient frontier to choose from for our, set of assets that we can invest in. Okay, so let's look at what I mean in the next slide. So as I already said, just based on the visuals, it seems that we can move our P to some other P along the red frontier such that our efficient frontier is expanded outward as far as possible. So, but that requires us to determine what this tangent portfolio is. Okay, so once we establish this tangent portfolio, it should be quite obvious which portfolios we should restrict ourselves to, right? So what I want to say eventually is that any point along the green line is going to give us what's called efficient portfolios. Anything below it is dominated because it's going to have lower returns or higher risk. That's the punchline here. All right, so as what's going to be stated in the next slide, the slope of this frontier is called the Sharpe ratio. All right, guys. In this slide, we're going to show you how I derived this expression here. So this expression is based on the two formulas you've seen already in the previous slide. So I'm just going to write for you here how this formula came about. So recall that the variance of our return, the variance of the return of the portfolio that includes the risk-free asset, I'm going to use P prime to represent that, is equal to the variance of 1 minus x times RF plus RP, x times RP. And remember that RF is constant, so it just goes away. That's going to give us the variance of RP, and then we multiply by x squared because we're factoring out the constant. And whenever you do that for variance, you have to square it. And then let's take the square root to get the standard deviation of RP prime. That's going to give us x square root variance RP. All right. And also recall that our return of our risky portfolio that includes the riskless asset RP prime is equal to 1 minus XRF plus x times expected return of our risky portfolio. We can rearrange this expression by multiplying RF out, and we should get RF plus x times expectation, x times expectation of RP minus RF. So I'm just rearranging the terms here, right? And then based on this expression here, we know that x is equal to SD RP prime divided by SD RP. And we can simply substitute this here. Okay? Once you do that, then we get this equation here. Okay? So in order to get the tangency portfolio, your goal would just be to maximize this. So max choosing X or W, XW, right? Whatever weight you decide to put on the riskless asset time, and also the weight on for your risky portfolio. So once you choose X and W such that Sharpe ratio is maximized, then you have found the tangency portfolio. Again, this is quite math heavy for those who are unacquainted with calculus. You can definitely do this in Excel, and I'll show you in a separate lecture video. But for now, this is just intuition. So remember, based on the previous slide, our goal was to kind of shift this portfolio that includes the riskless asset as far to the left, upward left as possible. We do this by choosing this P along the red frontier of risky assets. And once we shift it to a certain point, that's the point in which the straight line will be tangent to this C, the efficient frontier for just risky portfolios. Okay, that means that we will have found X and W such that the Sharpe ratio is maximized, and that will precisely give you the risk return at this point here. So again, I will give you the math in a separate lecture during our Zoom session, but for now, just keep in mind of the intuition, which is probably more important at this point. Okay. So let's go through some examples just to make sure we are on the same page. So on slide 19, you have to choose between two mutual funds. You have to choose a mutual fund with what's called mighty big returns. That just means that expected return has an expected portfolio return of 15% and a standard deviation, however, of 40%. And we have another fund called the Sleep Well Fund of 5% expected return and a standard deviation of 10%. The risk-free rate is 3%, and your task is to evaluate which mutual fund has better performance or has better risk efficiency. The trick here, again, is just to use the Sharpe ratio definition, because that's going to capture the optimal risk trade-off between portfolios. Okay? Remember, the tangency portfolio is the one that maximizes the Sharpe ratio, so the better the Sharpe ratio, the more efficient it is. So if you calculate the Sharpe ratio for mighty big returns, you'll see it has a ratio of the following: 15% minus the risk-free rate, which is 3%, divided by its volatility. That's going to give us 0.3. For the Sleep Well funds, it will have a Sharpe ratio that's calculated by taking the difference between 5% and 3%, but it only has a volatility of 10%. That will give us 0.2. So based on these mathematical calculations, mighty big returns, despite having more volatility, has a more efficient risk-return trade-off. And so you would definitely choose mighty big returns based on your preferences of having more returns and less risk. Okay, so now we're finally going to get to the assumptions of the capital asset pricing model. So what we've been talking about so far is just the portfolio construction for someone who has preferences for more returns and less risk. And we've outlined and defined a possible set of portfolios you should choose from. And what we concluded is that we should only choose the portfolios that are on the frontier. Either if you don't have risk-free asset access to, you should definitely choose only the red frontier. But if you have the riskless asset, you should choose that green line, right? That intersects the Tangency Portfolio and the risk-free rate. So any point along that line will give you the most efficient portfolio in terms of risk and return. Okay, and remember that Tangency Portfolio means that you're holding 0% in the risk-free asset, but you're holding all your money within the risky assets. Anything to the right of that Tangency Portfolio means you're leveraging at the risk-free rate and investing that borrowed money in the risky portfolio. Now the question is, all right, so when does this portfolio math actually can be used from a asset pricing perspective? So when we talk about asset pricing, we're thinking about markets that are in equilibrium. All right, equilibrium means everything is stable, prices are captured all information. There's no arbitrage left on the table, and nobody has any reason to change their position, right? That's the only case under certain conditions that we will outline now. All right. So we're going to make some strong assumptions for capital in order for this bond math to be translated into the capital asset pricing model. So first, we have to assume that investors can buy and sell at competitive prices. So in other words, that means that all investors can buy essentially unlimited amounts of trading, and there's no so-called efficiencies, right? There's many buyers, there's many sellers, and if you want to construct a portfolio, you can buy and sell basically infinite amount, and that's the assumptions we need in order for this portfolio math to actually make sense in equilibrium. So let's me outline what I just said. So that means unlimited amounts of trading, many buyers and sellers. Number 2, investors hold efficient portfolios. Remember when I said that efficient portfolios hinges on the fact that we dislike risk and we like returns. So by definition, that means we're assuming some structure on every investor's utility function on average or in aggregate. So in other words, we're saying that in equilibrium or in aggregate, utility function behaves as if we are minimizing variance and for a specific return. Okay, so the mean variance portfolio math can carry forward onto every individual as if in aggregate. So must have utility function on average or in aggregate such that people, or let's just say investors, are minimizing variance subject to some minimum return. Okay. And lastly, investors agree on expected returns, volatilities, and correlations. So again, what that means is that we're allowing investors to trade until information is sufficiently diffused in the system and there's nobody wants to change their mind anymore. So in other words, information is symmetric or perfect. All right, so under these assumptions, then all that portfolio math that we've been talking about can be applied to pricing assets. Okay? That's the takeaway from the CAPM. You have to assume that these are three assumptions hold. Then we can use all that portfolio math for deriving proper expected required returns on risky assets. Okay, so first things first, let's try to interpret these assumptions visually. We're assuming that we know the return and volatility of every asset out there. Okay, so that means we know what we know on average E should give us this amount of return for this amount of risk. We know that Anheuser-Busch should give us around 5% for this amount of risk. That's what it means to have perfect information. So if there's some sort of disagreement, we allow investors to trade, but as they trade, they will learn about other people's beliefs, and eventually they will settle on a equilibrium. Right? Nobody wants to trade anymore. In that case, no other information is relevant at the end of the day. So sigma squared I and expectation I is known. That's the third. Recall that is the third assumption for CAPM, and therefore no other info is relevant. All right. This is assumption 3. Assumption 2 means investors are holding efficient portfolios, and that basically means that everyone is holding a portfolio on this green line, right? People would only hold portfolios on this green line if they have certain specific utility function structure. And let me reiterate again, we are assuming that people are not risk loving, right? We're assuming that people are risk averse. They don't like risk. They want more returns. And if that's the case, then people will hold these efficient portfolios on this green line. And the question here is, what happens if everyone has access to the entire universe of assets, have access to the risk-free asset, and everyone has, risk-averse utility functions? So in aggregate, is there a economic intuition to assign to this tangency portfolio? And the answer, of course, is yes. As you will see, if we have these assumptions holding, this tangency portfolio is just another way of saying it's the market portfolio. Because there is one source of risk and everybody's holding a piece onto that risk, and if everyone's behaving similar, basically the same preferences in aggregate, that is behaving risk averse, having some structure to some specific structure to the utility functions, then there is only one source of risk, and that risk is how much everyone is holding onto the market. What proportion of the market portfolio is everyone holding onto? Okay, that is when supply is equal to demand, and that is the tangency portfolio. So that's what we're getting into in a few slides. Okay. Or in this slide. So let's summarize again. All investors have the same beliefs, which is what assumption 3 is saying. Again, that means that everyone agrees what the expected returns and the volatility is for every asset that can be included in the portfolio, and they hold efficient portfolios. So that means that everyone wants to hold some portfolio on the green line, and they can, given sufficient, ability to formulate their portfolios. So what this second question is asking you is, what portfolio of risky assets must all investors demand? And as I try to intuitively explain, that portfolio is the Tangency portfolio. So remember, the Tangency portfolio is the portfolio that doesn't hold any risky asset, but is but it holds all its investments so let me say that again. It's not holding any risky asset, it's investing all of its investments in risky assets. And the Tangency portfolio only intersects the frontier at a specific point. So what this is saying is that once we allow the economy to equilibrate, then demand for risky assets will equal to supply, and therefore the Tangency portfolio must be the market portfolio. Okay, so let me try to draw your attention again to the graph. Remember, Tangency portfolio literally means that there's an intersection point between this green line with the efficiency frontier for risky assets only, right? There's only one portfolio that everyone should hold. If everyone has the same belief structure, everyone's allowed to formulate portfolios, and everybody knows all the information about every risky stock out there. If that's the case, then, and they're also allowed to hold on to the green portfolio, the riskless assets, then everybody wants to hold onto the green line, some portfolio along the green line. And that green line is going to only intersect the frontier of risky assets at one point. And so basically, everyone is holding onto some proportion of the market portfolio. And what this is saying in this slide is that if that is true, then in aggregate, demand must equal supply, and therefore the Tangency portfolio must be the market portfolio because everyone's holding on to some proportion of it. And if you aggregate it, that's the entire market portfolio. So there's an implication here. So if you're only given a couple of assets, then the Tangency portfolio math is quite complicated. But if we're talking about a universe of assets, then the market portfolio is actually quite easy to calculate for a specific stock, for example. All you really need to do is calculate the share of its market capitalization with the total market capitalization of the market portfolio, right? For example, if we use the S&P 500 to represent the entire market of risky stock, then all we need to do to figure out what proportion of a particular stock is exposed to that risk, we simply just take the ratio between that stock's market cap or that company's market cap and divide it by the market portfolio. This is the implication, okay? So the math can be easy if we make those assumptions. Again, those assumptions are very strong. Remember, we have to assume three things. Number one, we have investors being able to formulate the portfolios, which requires buying and selling infinite amounts of assets. And number two, they have a specific utility function structure. As you'll see, because the variance has a squared component, that means that their utility is going to behave quadratic, looks like it's quadratic. And number three, we are assuming that information is eventually perfect in equilibrium. Okay, so there's no arbitrage. Everybody learned from everyone else, and nobody else wants to change their position. So everything's static. In that case, we have finally market equilibrium, and therefore the market portfolio must equal to the tangent, is the same thing as the Tangency portfolio. Okay, so market portfolio is the portfolio of all risky assets in the economy. It is what you get if you add up all the holdings of every investor in the economy. And as I already said, the market portfolio weight on asset I is quite easy to calculate. All you have to do is take the market cap of that asset. So if we're talking about General Electric, you take the market cap of that company and divide it by the total market cap of all assets. And typically for practitioners, we are lazy, so we don't need to, because we don't need to be precise. When calculating the total market cap of all assets, we can typically just use the S&P 500 or the Wilshire 3000, or maybe just all the stocks being listed in the Hong Kong Stock Exchange. That's perfectly fine. All right, so let's go over this example. Suppose there are only two assets in the economy, IBM and GE stock. The market cap of IBM is $2 billion of GE, and GE is $8 billion. So what is the weight on IBM in the market portfolio? That's quite easy. When there's two assets, it's simply just 2 billion over 2 billion plus 8 billion. And that should give you, plus 8 billion. That should give you 20%. Okay, so once you have the weights, you can easily weight your portfolio's return for each of these assets, and then you can come up with the overall return of the market, and that's all you really need, right? Is the market return. Very easy to calculate. But in the case in which you have, you don't have an economy of just two stocks, and you only have access to 5 stocks, for example, then the math to calculate the tendency portfolio is much more complicated. But that's just a heads up, okay? So for the homework assignment, you will have to calculate the tendency portfolio for a limited subset of stocks, and we can't assume that we have a 2-stock economy. All right, so definitions. We're going to go over some definitions now. So the green line, I called it the frontier, but we have a specific term in the textbook. It's called the capital markets line. So that just means that it's the portfolio that you can create from the market portfolio or the efficient portfolio or the tangency portfolio. They all mean the same thing here. So I'll write tendency portfolio here. And the risk-free rate, right? We're just choosing some weight between the risk-free return and the market portfolio return. And again, to remind you to calculate the market portfolio return, if we're just talking about the entire economy, you just take the ratio of market caps to determine the weights, which is the tendency portfolio weights, multiply by those returns and add them all up, which gives you the market portfolio return, right? Just the weighted average. Any point to the left of the tendency portfolio, you're having some positive weight in the riskless asset and some positive weight in the tendency portfolio. Anything to the right of the market portfolio indicates that you are leveraging, meaning you're borrowing money at the risk-free rate and you're putting more money in the risky portfolio. And as you can see, for some amount of risk here, the green line will exceed the returns for the risky asset frontier. Okay, so definitely the green line is the most efficient set of portfolios you should choose from, given that you don't like risk and you prefer having more returns. Okay, so reiterate, just to remind you again, the green line has a name. It's called the capital market line, and then again, it's to represent possible portfolios that you can choose from, and it gives you the set of portfolios to choose from. Okay, so it represents the relationship between the expected returns and the risk of the portfolio. Okay, these points obviously dominated, so any point on this inside or below the green line is dominated right? Because as I already said, the vertical line represents fixing the risk, and you can always get higher returns if you hold on to the green, some portfolio on the green line. So as I already said, the capital markets line you've already seen. It's simply just this formula you saw already, right? And we derived where the Sharpe ratio comes from. And that is our measure to represent compensation for risk. So just to remember, the capital markets line is representing the relationship between risk return of efficient portfolio, or the market portfolio, and risk-free asset. And you can calculate the Sharpe ratio simply by figuring out the slope, right, of the capital markets line. So slope of CML. Every other parameter is derivable, right? Standard deviation of your risky portfolio. You can calculate this easily with the weights if you know the weights. And yes, so that's what CML is. So this slide is just remind you again what CML tells you. Tells you that all stocks and any other assets, for that matter, are below the CML line are not efficient. And the way to see that is simply just to draw a vertical line anywhere, and you'll see that for any volatility level, you can always get better returns if you formulate a portfolio on the capital markets line. The capital markets line will always dominate anything below it. So there is a subtle implication based on this math. It's that you can't beat the market by simply investing in individual stocks. The only way you can beat the market is if there was a violation in the assumptions, and it's very difficult to figure out where the assumptions are being broken. But trust me, you can definitely find ways to break it, such as, for example, it's possible somebody may have superior information, right? That's one way to beat the market. Another way to beat a market is not beat the market, but you may be risk loving. That could actually lead to different outcomes. And there may also be liquidity issues, right? In which case people can't formulate portfolios they want to formulate. And any violation of these assumptions definitely will lead to possibly being able to beat the market. Right? So as I state here, right, you have to assume you don't have any better information than the other players in the market, and if that's the case, you can be profitable. But if those assumptions were holding, then you're better off simply just buying an index fund. So this is basically what finance practitioners and academics have been preaching for the last, I would say, maybe 50 to 80 years. Okay. All right, so we're almost there to the CAPM model now. So that's what we're going to talk about next, the capital asset pricing model. So what you should be asking is, all right, so we know what conditions must be met in order for everyone to hold a portion of the Tangency portfolio or the market portfolio. And if that's the case, now we should be able to figure out how individual assets should be priced, right? Because there's only one risk factor, and that's coming from the market portfolio. And the question, therefore, is how do we determine individuals' assets or stocks' exposure to the market portfolio? And we can do this through the beta, okay? So let me kind of give you a intuition again, where we started from and where we're headed. So recall that we can break down risk into two categories. with this initial equation that I've written at the beginning of this lecture. Recall that we tried to understand the return of an asset from two components, from risk-free asset and from the risk premium of the stock. So this is the additional compensation for holding on to extra risk. We're going to model that eventually. And based on last week's lecture, we learned that not all risk should be captured by this risk premium, because some of the risk can be eliminated through diversification. And remember, under close to perfect markets, diversification should be free to investors. And if that's the case, this asset pricing model shouldn't be pricing what's called idiosyncratic risk or non-diversifiable risk. So diversifiable risk. So so let me what I stated several times already last week. Not priced, since can be eliminated for free via diversification. Okay. So if that's the case, we can therefore represent this risk premium in the following way. We can represent it as some exposure measure to the market risk premium. So remember, based on our portfolio math, there is only one intersection between the security or the capital markets line and the efficient frontier. That intersection point is our source of risk, and basically we can represent all assets with respect to some scaling of that risk factor. Okay, and for our case, we're going to assume that it's going to be a linear function of that risk factor. So the capital asset pricing model can therefore be represented in the following way. It is equal to the risk-free rate plus some risk exposure to the risk factor of our expected returns minus the risk-free rate. So this is our market risk premium. If everyone in aggregate behaves as if they hate risk, they love returns, and also they're allowed to form portfolios fairly easily, and also there's perfect information, right? No insider trading. In that case, then we can estimate this model quite easily with ordinary least squares. So for those of you who have statistics, you know that beta has a form. We can represent that form here. So I think this is written on the next slide, but I'm going to give it to you here. Okay, so this is our beta coefficient or regression if we decide to regress returns on the risk factor plus some constant, right? And or the risk-free asset constant. As you can see, this is quite intuitive. The covariance term here is our exposure to the risk with the market, right? And the variance is like a scale factor. Right, so in this case, beta truly is a linear measure of exposure to the risk factor. So on this slide here, I reiterate what I said before. So for those of you who are curious how to estimate this using your statistical package or in Excel, you can run regression in Excel. You would estimate the following model, actually. Let me write what it looks like. Equal to alpha plus beta xt. Sorry. Let me just use regression variables here, so maybe that's clear. So we're going to rest the outcome variable or the dependent variable. T varies over time, some constant term plus beta xt plus epsilon t. So this is what we're regressing, but what you're actually going to be regressing is the expectation of Ri minus the risk-free rate equal to alpha plus beta expected return on the market minus the risk-free rate plus epsilon t. Okay, this is the constant term. This is your excess returns above the risk-free rate by the market portfolio. This is excess returns on your particular stock. And if the model is good, your alpha should be 0, right? Or not statistically different from 0. If the model is bad, you will get a non-zero alpha. That means that your assumptions are wrong, most likely, or there is some sort of inefficiencies in the market that's not being accounted for. Okay, and you may have to include additional factors, which is what a massive amount of literature has dedicated itself to. Discovering these additional factors to eliminate or make alpha irrelevant. All right, so that's what beta is in terms of regression. Of course, some people also write beta in the following way, which is fine, okay, right? We're just factoring out the standard deviations so that we're working with correlations instead. Same thing. Okay, so how do we typically visualize the CAPM model? We tend to visualize the CAPM model using what's called the security markets line. So remember, the SML is different from the CML. The CML is supposed to capture the set of portfolios that are efficient, that you should only consider, right? It's representing the portfolios that you should only consider because it's a portfolio of the risk-free asset and the market portfolio, the tendency portfolio. The security markets line, on the other hand, is representing something else. It's representing CAPM. So let me emphasize that by writing this here. So SML is representing CAPM. It is not to be confused with CML. So if CAPM is correct, then we should have a linear relationship between return and beta. Okay, return and beta. Beta, again, is our measure of exposure to the single risk factor, which is the market portfolio, the tendency portfolio. So if the model works, right? If the model is correct, then if we were to plot the betas and the returns, we should get something that falls along this line. But of course, the model definitely is not going to work all the time in reality. In fact, it breaks often. And you will definitely get some assets that are above and below this line. So these betas and Rs that don't fall onto the security market line is typically referred to as undervalued stocks, or something that's not captured by purely a market portfolio risk factor. There could be other risk factors that's not being accounted for. And these other assets that fall below the line, are deemed overvalued. The reason it's called overvalued is because the model says that they're undervalued because the model says that for this specific return, it's supposed to give you some. It's supposed to give you this specific. So let me give you an example here. So let's suppose that for this point here, the model. So I think I got this mixed up. This is overvalued. So for this point here, the model says that it should only give you this amount of return, but instead you observe this amount of return. And so over time, we suspect that this value will maybe converge back to the model implied return. And so these points are definitely overvalued. On the other hand, if we have observed returns that fall below this line, that means that for this specific beta, the model says it should have this amount of return, but it's actually underperforming. So if you believe the model is right, then we suspect that the returns may increase over time. Okay. And as I stated already, be aware that the capital markets line and the security markets line are not equal. Sorry, I was right the first time. So I just read my notes a little bit more. This should be undervalued. I was thinking in terms of prices instead of returns. So this is overvalued. So the logic is for the overvalued case, it means that the price needs to decrease so that returns increase. Same thing here. Price needs to increase so that R decreases. So in terms of prices, I was right, but in terms of returns, it's the opposite. So if we have returns that's above the market line, it means the price needs to increase, which means that it's undervalued. On the other hand, if you have returns below the line, that means that the price is too high and it needs to decrease so that returns increase. So that's something that was confusing for me too, but once you read it through, think through the logic a little bit more, and it should be quite obvious. Okay. Yes. So as I already stated, don't confuse the CML with the SML line. SML is supposed to represent the CAPM, and the capital markets line, or CML, is supposed to represent the efficient portfolios that's accessible for you when you that's the most risk efficient portfolios that you should only choose from, given that you are averse to risk and prefer more returns. Let's go through some examples now, just to make sure we know how to use the CAPM. So for slide 34, assume that the risk-free rate is 5% and the market portfolio has an expected return of 12% and a standard deviation of 44%. So let's TP oil and gas has a standard deviation of 68% and a correlation with the market of 0.91. The question asks you to calculate ATP's beta according to CAPM. What is APT's expected return? And we can definitely derive all that. So let's just write out what has been given to us. So the beta of ATP, we have that formula in the previous is given to us. Right, so I'm just going to use the formula 0.68 times 0.91 divided by 0.44. That's going to give us 1.4. And given the beta, we can apply the CAPM formula to get the returns on ATP. That is equal to 5% plus 1.4, which is our beta, times the market excess returns. That will yield 15%. Okay, so that's our model implied expected returns based on the CAPM given the beta. Slide 35, we have another example. So suppose we have a stock of a corporation called Hedgie, and it has a negative beta. Its expected return on the market is 14%, and the risk-free rate is 6%. So let us use CAPM to determine what the expected return of HC is, and see how it compares to the risk-free rate and whether it makes sense. So using CAPM, we have a beta we can just use the beta outright. So the return on Hedgie is equal to the risk-free rate plus negative 0.25 times 14% minus 6%, which is equal to 4%. Yes, it makes sense because it has risk, but it's negatively correlated with the stock market, so you can get something that has lower returns for sure, right? Because there's negative correlation with the stock market, so it makes sense. And slide 37 or 36. This is just a technical thing, so you can prove this yourself, but you don't have to. All you need to know is that if you're formulating a portfolio of many stocks, you can simply just take the weight and scale each of those betas by that weight to get an overall beta for your portfolio. You don't actually need to apply CAPM successively over and over again. You can just come up with a new beta by taking the weighted average of all the betas. So we can go through an example here. So suppose we have a stock of 3M company, and it has a beta of 0.69, and Hewlett Packard has a beta of 1.77. If we assume the risk-free interest rate is 5% and the expected return on our market portfolio is 12%, we can derive what the expected return on the portfolio of 40% 3M and 60% HP according to CAPM. So as stated in the previous slide, we can just simply take a weighted average. That is 40% times 0.69 plus 60% times 1.77, which is equal to 1.338. And then we can just then apply CAPM equal to 5% plus beta P minus times the excess returns, market excess returns, which is equal to 14%. Okay, so that's basically it. Estimating beta, of course, you don't have to do this at all in this class. I think I will give you an example of doing this yourself, but in practice, it's much easier just to look it up on Bloomberg or on Yahoo Finance, because beta is estimated by professionals all the time. But for those of you who are curious, you can. So I gave you two methods to do this if you want to try this out yourself. So we can do this by using historical average returns. But it's not clear how far back you should use to calculate the returns, because as you all know, the mean returns can change period by period, and it's not obvious beforehand whether or not you should include, for example, crisis periods like during the recent 2008 financial crisis, or the coronavirus crisis, or 9/11. These are all crises that have that can affect average returns, and it's not clear whether or not you should include these periods when deriving beta. Typically, somebody will use maybe just a few years back, and they may exclude certain periods, such as the coronavirus, to calculate mean returns and volatility. Yes. Okay. But ideally, you should use as long as history as possible, to be honest. So if you use, but not, again, the problem is because some stocks don't have a very long history, because they only recently went IPO. Okay. All right. So the method stated here is that you can use the beta from linear regression. And let's see. Okay, so in this slide, two things you can do. One is using historical data. Another is to use CAPM. And most people will use CAPM, but they will use a precise window of time which they think is relevant, that captures its most recent performance behavior, such as the risk-return trade-off, right? So that's hard to determine, but you can pull this beta from most websites, I believe. All right, so the market risk premium, I've already said this several times, which is just simply the difference between the expected return on the market portfolio and the risk-free rate. And we typically approximate this using the S&P 500 index or the Hang Seng index. And it's quite easy, because all you need to do is to look at the market cap of each individual firm and scale it by the total market cap of the index, and that should give you the weight to determine the portfolio return of the Hang Seng index or the S&P 500. So it's important to note that your return can differ from period to period in which you estimate. So the example here is, if you look at the interval between 1926 and 1920, you'll see that the excess returns is much higher if you use more recent data, right? So this versus means we're subtracting the S&P 500 returns from the 1-year Treasury yield. And so for our class, I would suggest to use 5%. Okay, but if you have a better number, for example, if you read some analyst reports, you should definitely use those numbers instead. Okay, you can just write it as a footnote in your project. Okay, so as I already said, in order to estimate beta, you estimate the excess returns on the stock, which is this variable here, and you regress it on the excess return from the market portfolio. Okay, so, and the estimated beta coefficient, therefore, is your beta. Alpha is something you want to be 0, right? It's the intercept of the regression. And you can certainly do this yourself in the example that I gave you in the module that I updated on Canvas. So you can work through the example, or I will work through it during our Zoom session. Okay, and the final topic is, what does beta alpha really represent? Alpha just means how well your model fits to the data. Okay, so if we believe CAPM to be true, then alpha should be statistically indifferent to 0. That means it should be very close to 0. But if not, then alpha means that some particular stock is outperforming this benchmark. Okay, and there could be many reasons why, such as the model assumptions are wrong, there's extra risk factors we're not accounting for, It could also mean there's imperfect information. There could be many reasons. But anyways, if you have alpha that's non-zero, that just means most likely your model is broken or incorrect. So in most cases, for practitioners in corporate finance, this is not a big deal for us because we can always do sensitivity tests. But for those people in portfolio management and asset pricing, this is important because you want to build models to beat. You want to build trading strategies that beats the models, right? The expected return. And if your benchmark model is wrong, then it's hard to gauge if your trading strategy is good overall. Okay. But in any case, it's hard to get a precise estimated alpha because we don't know if the model is wrong or is because the stock is actually outperforming the benchmark. But in any case, that's all I want to talk about in this lecture, and we will discuss more next week. So what we covered, let me summarize what we covered. We talked about construction of efficient portfolios, assuming we have some sort of, preference structure. We don't like risk and we like returns. In that case, to construct efficient portfolios, given the additional access to risk-free rate, we should only build our portfolios along the capital market line, right? That means we are building a portfolio of some tangent portfolio and some risk-free assets, and we should only hold portfolios along that line because any other portfolios below that line is dominated. Okay. Market equilibrium, just the conditions in which the portfolio math applies to the overall asset pricing model. We can use this math for the asset pricing model if everyone behaves as if they are risk averse, but they prefer more returns. There's no cost to forming portfolios. They can buy and sell infinite amounts of assets, and also there's perfect information. In those cases, and in addition to market equilibrium, we can apply this portfolio math for CAPM, right? Then we get what's called the security markets line, right? All right, and I talked about some ways to estimate beta, okay? And we typically do this through regression, ordinary least squares regression. But what you should think about is that, all right, you have the flexibility to choose the sample period, which is important, and it's sensitive, right? As I showed you, it's sensitive to the period of time you choose. Right, okay? But for our purposes, you should definitely just take beta from external websites because these people have thought about what's the relevant sample to determine the exact agreed upon mean return and volatility. So next week, I will talk about applying CAPM to valuation, but based on the ungraded homework assignment, it should be quite straightforward, right? You just use the CAPM to determine the cost of equity, and then use the weighted average cost of capital to formulate the discount rate for the entire firm, right? All right, so next Zoom session, I will summarize everything again and show you how what we talked about today can be applied to the ungraded homework assignment and also to your own final project for this course. That's all I have for you today. So if you have any questions, feel free to leave a comment or send an email, and have a nice day.